What's up everyone, welcome to another session. In this video we'll break down the idea of daily bias within smart money trading. Grasping the daily bias can boost your win rate by identifying stronger entry points and gaining a more defined perspective on the market's broader structure. When your entry models struggle on lower time frames, it's essential to determine the trend on the higher time frame. Although daily bias might appear complicated, this video is designed to turn it into a practical method anyone can apply on the chart. Here's what we'll be walking through in today's video, so if that sounds valuable, make sure to tap the like button to help us produce more content like this, and if you're new around here, don't forget to subscribe for more in-depth trading insights. So what exactly is daily bias in smart money concepts? Just like it sounds, daily bias means forecasting the market's direction and sentiment for the next trading day. In simple terms, it's an evaluation done on higher time frames like the weekly, daily and 4-hour charts to capture insights that don't show up on entry time frames. Now, a lot of daily bias strategies are too complex and lack straightforward instruction. That's why this video is here to introduce a clear step-by-step method. But first, let's ask why identifying the daily bias matters and what mindset supports it. Reason number 1: higher time frame zones carry more weight. Even a small reaction to a major level on a higher time frame can trigger a major shift on lower time frames. So before taking any position, we need to evaluate the distance to the next high time frame supply or demand zone. This allows us to properly define targets, place stop losses and stay out of bad setups. On the euro-dollar 1-hour chart, we observe a clear bearish trend, but once price couldn't break below the previous low and rejected that level twice, a reversal occurred. Now zooming out to the daily chart, it's evident this zone acts as strong support, so even with strong selling pressure on the 1-hour, we experienced a short-term bounce. Higher time frame key zones hold more weight because they more reliably highlight critical price areas where the market is likely to respond, thanks to their consistency and representation of broader market trends. Number 2: improving success rate. The most effective trade setups appear when both higher and lower time frames point in the same direction. Picture a situation on the lower time frame where we spot an inefficient move that breaks above previous market structure. In this case, if the price retraces to the order block zone, it sets up an ideal chance to go long, placing the stop just under the swing low and aiming for the next structure level ahead. Now consider when the lower time frame setup lines up with the higher time frame trend. Let's say the short-term uptrend is actually part of a larger bullish trend. This would make for a high probability trade as it merges higher time frame zones and directional outlook with a refined lower time frame entry. All things considered, the core idea behind daily bias in smart money concepts is to follow the footsteps of institutional players so we can structure our entries in line with that bias. Now that the foundation is clear, let's dive into how to identify daily bias using smart money concepts. To identify daily bias, we rely on 3 core concepts: supply and demand zones, liquidity zones and fair value gaps. We'll merge these insights to forecast upcoming price movement. Supply and demand: who currently dominates? Knowing which side holds control is critical as it helps us steer clear of avoidable losses. How does this framework operate? It's rooted in basic mitigation logic. If price returns to and mitigates a demand zone, then demand is in charge. If it revisits a supply zone and mitigates it, then supply is in charge. Our goal is always to align trades with the dominant force in the market. Let me walk you through it. Here we see a downtrend in motion made up of bearish, impulsive and corrective phases. Each time the market breaks structure, a new supply zone is generated. This becomes the nearest active supply zone, and as long as price remains beneath it, supply holds control. However, if price breaks and closes above this zone, then demand takes over and a new demand zone emerges. Now, if the bullish move continues and structure keeps breaking upward, every demand zone becomes a valid long opportunity because our bias is bullish. This bullish outlook holds until the price reaches an unmitigated supply area. Once it does, we pause the bullish view, since this zone can reverse price direction or spark a pullback, creating a tug of war between buyers and sellers. Price may then consolidate between supply and demand zones until dominance is re-established. Now, if price breaks the demand zone downward, it confirms that supply has taken over and short positions are valid until price hits the next unmitigated demand zone, which may serve as a potential bounce area. Alternatively, if price breaks the supply zone to the upside, demand is in charge and we can confidently look for longs until the price meets the next unmitigated supply zone. Now let's look at a candlestick chart example to better illustrate this who is in control concept. Here we're observing a sequence of lower lows and lower highs forming alongside a prominent supply zone. This specific supply area holds weight because it initiated a bearish imbalance along with a structure break. Therefore our bias is to the downside, and if price makes its way back to this level we can look for short setups with our initial target set at this recent low. Now we notice the price has failed to generate a fresh low and instead has broken through the supply zone to the upside, indicating that demand has taken the lead. Now our directional bias shifts to bullish and we look for buying opportunities at demand zones until price reaches the next untouched supply area just ahead. After tapping that zone we pause to reassess as no clear bias remains, and we must wait to see which force regains market control. All these illustrations so far were confined to a single time frame, but in practice we apply this method on multiple time frames. For instance, that demand zone might align with a major level on a higher time frame. Whenever you're evaluating the bias, start from the higher time frames and work your way down. One key point to remember is that lower time frames introduce more misleading signals due to increased volatility. Hence it's essential to ground your analysis using primarily the daily and 4-hour charts. This is also why setups based on price action generally perform better on the 1-hour chart compared to the 1 minute, as shorter time frames contain more market noise. Now, taking everything into account to figure out the daily bias, we begin by opening the daily and 4-hour charts and implement this method to assess which side currently holds control. After that we drop down to our chosen entry time frame to look for setups that are in sync with the higher time frame bias. The next principle to integrate into our chart analysis for building a solid strategy to define daily bias is the concept of liquidity. You've probably heard that liquidity is the driving force behind price movements, but where exactly is this liquidity located? It's not limited to just above swing highs or below swing lows. Liquidity exists at nearly every price point. However, the specific type we're referring to here is stop-loss liquidity. This form of liquidity is concentrated in areas where traders have placed their stop-loss orders. In the market, there are mainly two forms of liquidity: buy-side and sell-side liquidity. Areas above a single high or cluster of highs are considered buy-side liquidity zones, while areas beneath a low or group of lows are known as sell-side liquidity. Now you might wonder how this helps us determine the overall market bias. To answer that, we need to understand the mechanics behind algorithm-driven price movement. Algorithmic price delivery refers to the intentional price movement created by major banks and financial institutions to steer market activity toward key liquidity areas on the chart. Price action is either originating from a liquidity zone or aiming to reach one. It's about liquidity being collected and liquidity being targeted. When the market nears buy-side liquidity zones, bearish participants may initiate short positions or secure profits on their earlier shorts. At the same time, breakout traders might enter long positions if the price breaches this level. The swift move intended to capture this liquidity is referred to as a buy-side sweep. It's pushing higher to trigger stops positioned above the equal highs. This engineered move activates liquidity by trapping participants on both ends, and then the smart money takes the opportunity to enter short when price reaches this level. Bullish participants often initiate long trades or defend their existing positions simultaneously. Breakout traders could enter short if this level is broken. The sharp move designed to absorb liquidity is termed as sell-side sweep. This manipulated motion targets liquidity by catching both sides off guard, allowing smart money to position itself long. This type of broader analysis is focused on gauging the market's directional flow rather than pinpointing trade entries. You're free to utilize any method to enter trades, but make sure to test your strategy on historical price data across multiple instruments before risking live capital. Now, looking at the chart of the dollar on the 4-hour time frame, we see a clear demonstration of price moving towards zones of liquidity. Here the cluster of equal highs indicates buy-side liquidity, while the equal lows highlight sell-side liquidity. The market first ascends to tap into the buy-side liquidity before dropping to reach the sell-side levels once more. After clearing the liquidity beneath these equal lows, price then aims upward to capture buy-side liquidity above this supply zone. This pattern repeats itself several times until the market finally resumes its initial bearish momentum. Although institutional price delivery can significantly influence movement, it cannot override the primary directional bias. Keep in mind that trading focuses on anticipating future price action, and the future is inherently uncertain. You can't account for every potential outcome, but with experience and observation you'll begin to notice recurring market behaviors that show up time and again. Now, the next important concept to focus on when identifying the daily bias is the fair value gap. These zones play a key role in understanding where price is likely to return before continuing in its intended direction. Essentially, a fair value gap, FVG, highlights an imbalance between buyers and sellers, visually represented by the gap between the wicks of 3 consecutive candles on a chart. Typically, this gap indicates a buy-side imbalance, where buying pressure overwhelms selling, often triggered by institutional activity. This sudden momentum leaves behind an inefficient price range, and the market usually revisits it to fill that gap for smart money traders. Spotting the fair value gap should be your go-to move as soon as you open your chart. Your eyes should instantly lock onto it. It's a signal that big players have left their mark, and price is likely to return to that zone to fill unexecuted orders if those orders still exist. This becomes a prime opportunity for a well-aligned entry. On the EUR1 United States dollar H chart, we're clearly in a bearish trend. The latest impulsive move kicked off from this point and extended all the way down here. During this move, we saw strong sell-side imbalance, marked by large bearish candles that left behind multiple fair value gap (FVG) areas. Since the market has become buy-side inefficient, price is expected to retrace into these FVG zones to patch them over. This retracement often sets up solid short entries, especially when price rejects the FVG and resumes the downtrend. Just like we saw here, price pulled back to the gap, rejected it clean, and continued dropping. Now, this concept isn't just for the lower timeframes. FVGs show up on all timeframes and work just the same. Flip over to the EUR USD daily chart, and you'll see a gap between the low of one candle and the high of the next. That middle candle had aggressive selling only, leaving no balanced price action behind. So we mark that zone and expect price to revisit it eventually, possibly offering another setup. That's the core principle of the fair value gap. When you spot it, you're seeing where institutions made their move, and where price might return to rebalance the order flow. Let me break down how to combine all the concepts we've covered to identify higher time frame bias. Your higher time frame depends on your entry time frame, and should usually be 2x higher for solid confirmation. In most cases, we use the 4H, daily, and weekly charts to determine the overall market direction before looking for entries. Now let's analyze the NZD, 4 United States dollars hour chart using the concepts we've discussed. We can clearly see a series of bearish movements, so let's begin with the supply and demand framework. The most recent bearish break of structure has left behind an unmitigated supply zone, making it our key area of interest. As long as price remains below this zone, our bias stays bearish. Next, let's identify the liquidity. A large amount of buy-side liquidity has accumulated above this resistance level, meaning a liquidity grab or run above that area could trigger a sharp reversal, confirming bearish momentum. Now, looking at price imbalance, we can spot a fair value gap, FVG, formed during the latest impulsive move. By applying the Fibonacci retracement tool, we see that this FVG is positioned within the premium zone, making it an ideal area to watch for a price reaction. What's the plan? We wait for the price to retrace back into the FVG, then drop down to a lower time frame to watch for reversal confirmations, potentially giving us a high probability short setup. That wraps up this breakdown. If you found this content valuable, hit that like button to show your support. And if you're new here, consider subscribing for more trading insights. Catch you in the next episode.